Usually when we talk about a financial earnings report, there's this expectation of precision, right? You look at a balance sheet and it's kind of like looking at a medical x-ray.
Right, yeah.
The revenue line goes up, the profit line goes up, and the market just points at the scan and says, yep, there it is, perfect health.
Well, we want things to be binary in finance. Up is good, down is bad. It's clean and it's comforting. We like to categorize performance instantly.
But then, you step into the world of big tech valuations in 2026, and suddenly that x-ray machine seems completely broken.
Oh, completely.
We are looking at a market landscape today that is incredibly murky. So welcome to the deep dive. Today, we're taking all the sources, the reports, analyst notes on Apple's latest quarter, and we're exploring a massive puzzle that has Wall Street entirely tied in knots.
Yeah, it's a big one.
Apple just hit a staggering $5 trillion market cap. They reported a record June quarter revenue Q3 of 2026 of $109.4 billion, and their earnings per share came in at $2.02.
Which is an incredibly important metric to isolate for a second. For anyone tracking this, Wall Street analysts were only expecting $1.90 for the earnings per share.
Right.
So Apple didn't just beat the street's expectations. They decisively crushed them.
Exactly. They completely smashed the records. Yet almost instantly after these numbers dropped, the stock price fell between 4 and 6% in after-hours trading.
It's the absolute definition of diagnostic muddy waters. You have what looks like perfect health on paper, but the market's reaction suggests this deep underlying anxiety about what's coming next.
So our mission for this deep dive is to figure out what the X-ray is actually showing. We need to understand why Wall Street is sweating profusely during a record-breaking quarter.
Right.
And more importantly, what it means for you, whether you're tracking your own investments or you're just a tech fan or, you're looking to buy a new device this holiday season. Because these financial currents actually dictate the reality of the technology that ends up in your pocket.
And to do that, we have to establish a core rule of how the market operates. In the financial world, expectations and future headwinds matter significantly more than past records.
Wait, so past success doesn't buy them any goodwill?
Not really, no.
Yeah.
A company can post the greatest quarter in human history, but if the horizon looks even a little bit stormy, the market is going to price in the storm, not the sunshine they just walked through.
See, as someone who just loves the consumer side of this, I look at the sheer scale of Apple's reach right now, and I'm just marveling at it. 2.5 billion active devices in the wild.
It is massive.
But I know you're going to keep us grounded in the financial realities and those future storms you mentioned.
I will certainly try. But to understand why Wall Street is anxious, we first have to establish what actually went right. Because the hardware numbers Apple just posted were absolutely staggering.
Oh, totally.
And they created a massive baseline of success that makes that stock drop seem so contradictory.
So let's start with the hardware superstars. The iPhone is obviously the crown jewel here. iPhone revenue grew 22% to $54.25 billion.
Yeah.
And reading through the data, this wasn't just a general lift across older models. This was driven specifically by the iPhone 17 series.
Right. Counterpoint research showed the iPhone 17 was the global best-selling smartphone in Q1 2026.
Which is wild.
Taking a 6% market share all on its own.
That is a remarkable footprint for a single device model.
It really is. And the iPhone 17 Pro Max and the Pro took the next 2 spots. To put that into perspective, the top 10 smartphones globally captured 25% of all sales.
Wow.
That is the highest concentration ever recorded. People are gravitating heavily toward these premium models, even though the broader electronics market has been dealing with component shortages.
And it wasn't just phones, right? Mac sales didn't just grow. They jumped almost 29%, hitting $10.35 billion. And the sources point heavily to the new MacBook Neo as the driver there.
The MacBook Neo is fascinating. It's driving what Apple is calling the switcher effect. They noted that about half of all U.S. education purchases of the MacBook Neo were actually replacing Windows and Chromebook devices.
Wait, half of them?
Yeah, half.
But why is that happening now? Schools have loved Chromebooks for years because they're, cheap and easy to replace when a student inevitably drops one.
It comes down to total cost of ownership. While a Chromebook might be cheaper on day one, schools are finding that Apple's custom M-series chips inside the MacBook Neo run so efficiently that the laptops essentially never overheat.
Ah, right.
The batteries last all day for years, and the actual lifespan of the device is significantly longer. When you stretch the costs out over 5 years, schools are realizing that Neo is actually a better financial bet.
And we saw a specific anecdote highlighting this, right? Pinellas County Schools in Florida is transitioning 25,000 students directly from Windows devices over to the MacBook Neo.
Exactly. And it's bleeding into the corporate space, too. Morgan Stanley just deployed over 20,000 iPhone 17 devices to replace employee-owned phones.
20,000.
Yeah, citing a need for stricter liability and security controls.
Okay, let's unpack this, because the MacBook Neo is essentially acting like a Trojan horse, right? It's infiltrating these massive enterprise and education sectors, pulling tens of thousands of users from Windows and Android directly into the Apple ecosystem.
Yes, exactly.
So if they are successfully infiltrating schools and Wall Street banks with new hardware, why isn't this massive hardware success enough to keep investors happy?
Because Wall Street views hardware as just the entry ticket. Getting people into the ecosystem is great, but the market values the recurring revenue of that ecosystem far more than the one-time hardware sale.
Right.
And that ecosystem revenue, which Apple calls its services division, is exactly where Apple missed the mark this quarter.
Okay, let's walk through those numbers because at first glance, they look huge.
Yeah.
Services hit $30.7 billion for the quarter, and they reached 1.5 billion paid subscriptions. That's 1.5 billion subscriptions running across that active install base of 2.5 billion devices.
It's an astronomical number.
I mean, it sounds like they are basically printing money. If they have 2.5 billion active devices and 1.5 billion subscriptions, why is Wall Street punishing them for a tiny percentage miss in services? Is the market just being greedy, or is there a real crack in the armor?
If we connect this to the bigger picture, it's less about greed and more about identifying ceilings. At Apple's massive scale, a small miss indicates a potential ceiling on their growth engine.
Okay, that makes sense.
You really have to look at the structural reasons why they missed. The biggest one right now is regulatory pressure in Europe. The European Union's Digital Markets Act, or DMA, is actively pressuring Apple services revenue.
How exactly does that work, though? How does a law in Europe directly shrink Apple's revenue line?
Well, without taking any sides on the politics of global regulation, purely from a financial reporting standpoint, the EU is basically saying Apple can no longer force developers to exclusively use Apple's payment systems.
Oh, right, the 30% cut?
Exactly. For years, Apple has taken a 30% cut of almost every digital transaction on an iPhone. The DMA allows developers to point users to outside payment methods or even alternative app stores, which directly threatens that high-margin 30% cut Apple relies on.
Oh, so it's like a structural leak in the boat. It's not just a bad quarter, it's a fundamental change to how they make money overseas.
Precisely. And that wasn't the only regional miss. Greater China revenue hit $18.8 billion.
Right.
Now, that was a rebound from previous quarters up 22%,
Right.
but it still missed the $19.6 billion estimate the market had set.
What's driving that gap in China?
Intense local competition. Companies like Huawei and Xiaomi are making incredibly competitive high-end phones locally. Huawei in particular has seen a massive resurgence. Yeah, there's a strong sense of local brand loyalty, and they are offering features tailored very specifically to the Chinese market, which is eating into Apple's market share. Add to that a projected 2.5% foreign exchange headwind going into the September quarter.
Just to make sure we're totally clear on that, for everyone, a foreign exchange headwind means the US dollar is very strong right now, right?
Yes, exactly.
So when Apple makes money in Europe or Asia and converts those euros or yuan back into US dollars for their balance sheet, it essentially shrinks.
That's a perfect summary. The money they earn overseas literally translates to fewer dollars at home. And there's one more detail hidden in the margins that spooked investors.
Oh, what was that?
Apple reported a 50.1% gross margin, which looks incredibly strong. But if you read the fine print in the earnings report, that was artificially propped up by a 2% tariff refund.
Wait, a tariff refund? What does that mean in this context?
Basically, Apple overpaid import taxes on components they brought into the U.S. in previous quarters.
Yeah.
The government realized this and cut them a refund check.
Seriously?
Yeah, that one-time cash infusion made their profit margins look better than their actual day-to-day operations would have dictated. Without that refund, the margin would have just been average.
Okay, so going back to our X-ray analogy from earlier, when you peel back the layers, the bones, the hardware sales are incredibly strong. But the connective tissue, the recurring services, the international growth, the profit margins, is showing some stress fractures.
Yes, and Wall Street isn't just reacting to the services miss. They are looking ahead to a severe physical roadblock that is actively threatening the upcoming holiday quarter. And this is where we pivot from digital software sales to cold, hard physical supply chains.
Man, this part of the earnings call really stood out to me. Tim Cook actually used the phrase 100-year flood.
He did, and he was referring to exponential price hikes in DRAM memory.
Right, and for anyone who hasn't built a computer recently, DRAM is essentially the short-term memory of a phone or a laptop. It dictates how many apps you can have open at once without the device slowing down. So why are the prices for it spiking like a flood?
Because of the broader AI boom, massive tech companies are buying up all the global memory supply to build out their giant cloud server farms. And you have to understand, the DRAM market basically relies on only three primary suppliers globally.
Only three.
Only three. There isn't endless manufacturing capacity. When memory prices spike because cloud companies are hoarding it, it eats directly into the profit margins of every single iPhone and Mac Apple sells, unless they raise prices for the everyday consumer.
So Apple is basically fighting cloud AI companies for physical parts. But it's not just memory, right? It's the actual brains of the operation, too. The sources mentioned a squeeze on advanced chip nodes.
Correct. There are severe supply constraints on the advanced chip nodes used to manufacture Apple's system on a chip. These are the cutting-edge manufacturing processes required to make the chips smaller, faster, and more battery efficient.
I was reading an analogy about this recently that helped it click for me. Creating these advanced chip nodes is like trying to draw an incredibly complex roadmap of a major city, but you have to draw it on a single grain of rice.
That's a great visual, yeah.
Right. And when the manufacturer runs out of the highly specialized lasers required to draw that map, it doesn't matter how much money Apple throws at the problem. You simply can't make them any faster.
Exactly. And the real irony here is that this isn't a supplier failure. It's a demand forecasting issue on Apple's end.
What do you mean?
Well, the iPhone 17 and the MacBook Neo are selling faster than Apple predicted.
So what does this all mean? Like, they essentially threw the party of the century but ran out of cups because twice as many people showed up.
That's exactly it. And now, the supply chain has zero flexibility to ramp up for the critical holiday inventory. Apple expects their revenue growth to slow to between 9 and 11% next quarter, simply because they cannot physically make the devices fast enough to meet demand.
So to bring this back to the listener, if you're planning to buy a new iPad or maybe upgrade to that rumored iPhone Fold this December, you might actually have a really hard time finding one in stock.
Most likely, yes.
This isn't just a Wall Street problem. It translates directly to out-of-stock notices during your holiday shopping.
That is the direct, real-world application of advanced node constraints.
But wait, let's look at their digital strategy, because this is where the puzzle gets really compelling. While Apple is spending heavily to fight these physical supply chain fires, they have a totally different financial strategy playing out when it comes to artificial intelligence.
Yes, their AI strategy is arguably the most critical financial pivot the company is making right now.
And it seems to be what's actually protecting them from taking an even worse beating from investors. Because if you look at Alphabet and Meta recently, their stocks have been heavily punished by Wall Street for massive, unproven capital expenditures CapEx on giant AI data centers.
Oh, absolutely punished.
They are spending tens of billions of dollars physically building massive server farms to run their AI. But Apple isn't doing that. They're purposefully avoiding that massive server farm CapEx. The analysts are calling it Apple's AI safety play.
It's a stark contrast in philosophy. Instead of pouring billions into physical data centers like Meta or Google, Apple poured a record $11.73 billion into quarterly research and development.
Just in one quarter.
Just one quarter. That is up 32% year over year, bringing their total R&D spend to over $34 billion for fiscal 2026.
That is a staggering amount of money going into R&D, and we know exactly what it's funding, the rollout of Apple Intelligence and the new Siri AI.
Exactly. And they need this to work because the data is telling. Currently, daily usage of Siri among iPhone owners sits at just 17%.
Wow, that low.
Yeah, it's largely seen as a utility for setting timers, not a true AI assistant. But with this new R&D push, that number is expected to surge as the new Apple Intelligence becomes deeply integrated into the operating system. However, we have to note that the rollout is heavily fragmented globally.
Because of the regulations we were just talking about, right?
Yes. The new Siri AI and Apple Intelligence features are currently blocked in the European Union due to those DMA regulations. The EU wants guarantees about how data is handled and how third-party AI can integrate with the system.
Okay, that makes sense.
Meanwhile, over in China, Apple just recently received approval to ship the original basic features of Apple Intelligence, like photo cleanup, so it's not a unified global launch.
Here's where it gets really interesting, though. I'm trying to piece this financial strategy together. Meta and Google are spending billions on real estate and servers because their AI lives in the cloud. Apple is pouring money into R&D for the software that runs on the phone itself.
Right.
Is Apple secretly winning the AI war by forcing the AI to live directly on our devices, letting them skip the massive server costs their rivals are bleeding cash over?
What's fascinating here is that you've hit on the exact financial brilliance of their strategy. By utilizing the neural engine inside the local device, the chips inside your iPhone or Mac Apple fundamentally shifts the cost of computing away from centralized, highly expensive cloud servers and pushes it directly onto the consumer's hardware.
That's genius. So when I buy an iPhone, I'm essentially buying a tiny AI server for them. Apple gets my money for the hardware, and they don't have to pay a massive electricity and server bill every time I ask Siri a complex question.
It is highly efficient from a margin perspective. But I have to warn that this strategy carries significant risk.
Like what?
Well, it requires flawless software execution. To compete with the sheer brute force of cloud-based AI models from their rivals, Apple's on-device models have to be incredibly optimized. If the on-device Siri AI isn't as smart, or if it hallucinates more than the cloud-based alternatives, consumers will notice instantly.
Yeah, they definitely will.
It's a high-wire act of balancing cost efficiency with top-tier performance.
And navigating that exact tightrope, balancing this staggering hardware demand, the physical supply chain crises, the EU regulations, and this massive pivot to on-device AI, that is a monumental task. And the person who has orchestrated it all is finally stepping down.
Yes. This earnings call marked the end of a historic tenure. It was Tim Cook's final call as CEO.
It really is the end of an era. John Ternus officially takes the helm on September 1st, 2026. And reading the transcripts of the call, you can already see the transition happening in real time.
You really can.
Ternus was incredibly active, basically acting as the leader already, fielding the tough, forward-looking questions from analysts.
He was. The analysts were pressing him about the broader competitive landscape. They were asking about the threat of OpenAI potentially building their own hardware, or SpaceX launching satellite phones that bypass traditional carriers entirely.
Those are tough questions.
Very. And Ternus had to step up and project total confidence in Apple's long-term roadmap.
So, looking at this entire deep dive, the hardware boom, the memory crunch, the AI investments, what is the absolute first fire John Ternus has to put out on September 1st?
He is inheriting a company that is, paradoxically, a victim of its own massive hardware success. The very first fire he has to fight is that holiday supply chain crunch.
Oh, for sure.
He has to somehow secure those advanced chip nodes and navigate the global DRAM memory price spikes to ensure that iPhones and Macs are actually on the physical shelves in December. Simultaneously, he has to address the regulatory roadblocks choking their services revenue in Europe, all while executing this massive high-stakes pivot to on-device AI.
That is truly a baptism by fire.
It absolutely is.
And for you listening, this is exactly why diving into these earnings reports matters. Whether you're tracking your investments, or you're just wondering why your next iPhone might be harder to find this December, or you're curious why your phone suddenly has completely new AI capabilities built directly into it.
Right.
These deep financial currents dictate the actual technology that gets built.
Absolutely. The balance sheet isn't just a list of numbers. It is the fundamental blueprint for what you will be using for the next 5 years.
Which leaves us with a final thought to ponder. Apple is betting tens of billions of dollars in R&D that the future of artificial intelligence is highly personal, highly secure, and processed right on the device you already own.
And if Apple's AI safety play actually succeeds, if they can deliver top-tier AI entirely on-device without incurring those crippling infrastructure costs, will it render the trillion-dollar cloud server farms currently being built by their rivals entirely obsolete?
It really makes you wonder who is reading the X-ray correctly, doesn't it? The market punishing Apple today, or Apple getting on the hardware of tomorrow. Thank you for joining us on this deep dive into the numbers. Keep questioning the headlines, and we'll catch you next time.